Now that Donald Trump's won the election, it seems a natural assumption that Donald Trump is going to be great for the real estate industry. Today, we're going to address the issues regarding his presidency and find out whether or not this actually is going to be good for real estate or if it's simply irrelevant. So with us today is Brad Malkin, the owner and principal of Noble Home Loans. So Brad, tell us your thoughts on the Donald Trump presidency, but first off, can you explain to us whether or not the interest rates going up right now had any direct correlation with his presidency, or if it just is just simple coincidence?
Yeah, so it's not coincidence. I would say that if you looked from election night forward, you would see that the 10-year U.S. Treasury note, which most closely correlates to mortgage rates, was trading somewhere in the mid-180s the night of the election. When news came out that Donald Trump was likely to be the president-elect, the 10-year traded all the way down to 172 in those few hours. You may have also seen that the stock market futures tanked. They were down 850 points that night. And then there was some immediate reaction that President-elect Trump was going to move forward on an extensive bill to fix roads and bridges, and there was going to be a $1 trillion bill that was going to be moved forward to help improve infrastructure. Well, the markets read that as very inflationary. Inflation is like cold water on the wicked witch to bonds, okay? I mean, it's the one thing bonds cannot handle is inflation. So at that point, bonds reversed course, so did stocks. The $1 trillion was looked as very expansionary growth. Stocks loved it. They end up closing, not only reversing the 850 loss, but closed up 300 that next day. The 10-year immediately jumped from the 170s. I think we closed close to 2% that day, and it's just been off to the races ever since. And the expectation is that Trump is going to drive growth. Growth is going to drive inflation, which is something we've not had in the market for years. Inflation is just the one component that bond traders and the bond market can't withstand. And
Sure.
That's the reason why rates have moved up. We're up more than 50 basis points, a half a point in rate. It's been in 20 years, or in the years I've been in business, in mortgage lending, it has been the quickest jump in rates that I can remember.
Wow. So we've already experienced that effect. Now, moving forward, I mean, we still don't quite understand what his policy is going to be, but moving forward, what do you expect from Donald Trump's presidency based on what we've learned so far? What would you expect his effect is going to have on lending in general?
Right. So I think that what you're seeing is now a very quick rebalance. Okay. I don't know that anybody knows what to expect from the presidency at this point. It's difficult to pinpoint it. His nomination for Treasury Secretary Steve Mnuchin certainly knows banking. He knows he used to own. IndyMac morphed into a new bank that he created called One West Bank. That was his bank until he sold it to CIT Group. He understands banking. He came from Goldman Sachs. He has a long history of learning in our space. He knows how important housing is to the economy. Not only does it create jobs, but it creates buying houses, owning real estate is the single biggest wealth producer for families over a lifetime. Everybody understands that. Trump understands it as well. And so I would expect that we're going to see some rebalance. And that's where you are right now. People are worried about inflation. They sell bonds. When they sell bonds, the price of that bond goes down. The price and rate component or equation of bonds is inverted. So as price goes down, rates go up. And that's what we're seeing right now. We're just seeing a rebalancing. Yes, it's a little bit painful right this moment. I don't expect that it's going to continue to be painful. I think that we're going to come to a new normal very, very quickly. I think rates are likely going to improve a bit from here, but it just may take a little bit of time.
Okay. So do you think it's possible that we'll have any unintended consequences as a result of his presidency? I mean, obviously, as a developer and as very familiar in the banking industry, his goals should be to boost housing and boost the real estate industry. But we also have learned that there's unintended consequences beyond just trying to stimulate one market.
Sure, and I would say to you that absolutely, I would always expect there to be unintended consequences. I think that just in this last move of rates, the applicant pool that will benefit from a refinance has been cut in half. It's an incredibly large number. It's 4 million people that now no longer will benefit from a regular refinance.
And see, now that's amazing, and that's something we're going to cover in one of our future videos, because that's something that no one's even talking about right now. Well, I think that's a good place to end.
Okay.
Thank you so much for watching. Please subscribe, stay tuned, and we'll have future videos coming.